Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Dragonfly Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath. Imagine finding a company sitting on what looks like, honestly, the holy grail of battery technology.
Yeah, the literal holy grail.
Right. I mean, we are talking about 179% year-over-year growth in key sectors, 400,000 units already deployed out in the wild, and a manufacturing process that could, well, legitimately revolutionize the power grid.
It's massive, but, there's a catch.
There's a massive catch. Imagine that same company is currently trading for the price of, like, a mid-sized apartment building because it is just choking on $65 million in debt.
Yeah, that's the reality here.
That is the exact, incredibly tense tug-of-war we are looking at today. For those of you listening, we're analyzing a domestic leader in the lithium power system space. So those systems powering recreational vehicles, marine vessels, solar setup.
Massive off-grid deployments, yeah.
Exactly. And for your wealth-building journey, this analysis is just incredibly timely.
Yeah.
The company just wrapped up its Q4 2025 earnings call yesterday, March 16th, 2026.
Right, so we are fresh off the press here. And it's a classic market standoff.
It really is.
And it is exactly the kind of scenario where you, as an informed investor, can find a serious edge. But to really understand the wealth-building context here, you have to look past the immediate stock price and really examine the sheer physical scale of their operations.
That's if they're not small.
No, not at all. We are not talking about some speculative startup, sketching out battery concepts in a garage and hoping for a buyout.
Right, selling vaporware.
Exactly.
Sure.
Since 2021, Dragonfly Energy has generated over $225 million in actual realized revenue.
Wow.
Yeah. That is serious, sustained capital flowing through their ecosystem, and it's driven by tangible products already in the market.
And, they are attacking that market from two very distinct angles, which I actually find brilliant.
The dual approach.
Right. They have their direct-to-consumer side, and then they have their original equipment manufacturer or OEM segment.
Right, the B2B side.
Yeah. And if you have ever looked into upgrading an off-grid power setup yourself, you almost certainly come across their consumer brands like Battleborn and Wakespeed.
Oh, absolutely. Battleborn is huge in the RV community.
Totally.
Yeah.
But the metric that completely jumps off the page and just demands your attention is that OEM growth. They are sitting on a staggering 179% average annual OEM growth since 2021.
It's almost unheard of in hardware.
It is. Okay, let's unpack this.
Yeah.
179% average annual growth, it's just explosive. When I see a number like that in the manufacturing sector, it immediately reminds me of the classic Intel Inside strategy from the 1990s PC market.
Oh, that's a really good comparison.
Right, because they aren't just selling a battery that you pop in and out. They are becoming the central nervous system of the product itself.
Yeah. That is the perfect framework to view this through because it highlights the mechanical reality of what they're actually making. I mean, think about what goes into building a modern luxury RV or like a high-end marine vessel.
Right, it's practically a house on wheels.
Exactly. The manufacturer isn't just dropping a standard battery box in the trunk and calling it a day. They are routing custom wiring harnesses, integrating specific inverters and calibrating digital battery management systems into the very walls and chassis of the vehicle.
Which means once you integrate a specific power system into the literal bones of your product, you don't just swap it out on a whim.
No way.
Just because, a competitor offers a battery for $50 less.
Yeah.
The engineering alone to rip out that entire ecosystem, redesign the schematics, and install a competitor's system is, it's a massive logistical nightmare.
It is, and that nightmare is the foundation of what we call high switching costs. It is perhaps the single strongest competitive advantage a company can build in the industrial sector. When a manufacturer designs their flagship RV around Dragonfly Energy's integrated lithium systems, they are effectively locking themselves into a multi-year partnership.
Because it's too painful to leave.
Exactly. And what is crucial for you to understand, looking at this as an investor, is the deployment scale backing this up. They already have over 400,000 battery packs actively deployed and functioning in the field.
400,000. That is a massive footprint.
Mm-hmm.
But wait, let me play devil's advocate here.
Go for it.
If this market is really that lucrative, right, and it's growing at nearly 200% a year, what is stopping a massive overseas conglomerate from just swooping in, reverse engineering the setup, and undercutting them with a flood of cheaper imported lithium batteries?
like a race to the bottom on price.
Yeah. Why can't someone else just be the Intel Inside for half the price?
Well, because the batteries themselves are fundamentally different at the molecular and manufacturing level. Yeah. The primary competitive moat protecting Dragonfly Energy, and the exact reason they aren't easily undercut, is their proprietary dry electrode cell manufacturing process.
Okay, let's break down the mechanics of that because a lot of standard lithium battery production uses a wet slurry, correct?
Yes, exactly. A highly toxic wet slurry.
So what is the actual engineering hurdle they solved here that no one else could?
Okay, to understand the breakthrough, you have to understand the traditional nightmare of making a battery. Standard manufacturing relies on mixing active lithium materials into a wet, almost paint-like slurry.
Right.
And to make that slurry work, you have to use highly toxic liquid solvents, specifically one called NMP.
NMP, got it.
So you coat the battery foil with this toxic wet mix, and then you have to run that foil through massive, literally warehouse-sized drying ovens.
To bake off the liquid.
Exactly. These
Yeah.
ovens run constantly at incredibly high temperatures just to evaporate that toxic solvent. It is incredibly slow, it requires a massive factory footprint, and quite frankly, it is highly hazardous.
So how does Dragonfly do it differently?
Dragonfly's dry process skips that entirely. They literally press the active dry powder directly onto the foil without any liquid solvents.
Wow. No ovens at all.
No massive drying ovens. Plus, it is PFAS-free, and it completely avoids those toxic NMP chemicals.
Okay, I want to push back on the environmental angle for a second here.
Sure.
Because, look, being PFAS-free and avoiding NMP sounds great for an ESG brochure, but does the market actually care, or is that just corporate window dressing?
Oh, no. The market cares deeply because it is a massive regulatory moat.
Really?
Yes. PFAS are often called forever chemicals, and they are currently facing sweeping, aggressive bans from the EPA in the U.S. and regulatory bodies all across the European Union.
Oh, so the hammer's coming down.
The hammer is definitely coming down. Companies relying on toxic NMP solvents are looking down the barrel of massive future compliance costs and severe supply chain disruptions.
Makes sense.
By completely eliminating those chemicals from their process today, Dragonfly Energy is entirely insulated from those upcoming regulatory crackdowns.
Okay, here's where it gets really interesting. Because the underlying data points out that this dry electrode process is chemistry agnostic.
Yes, that is the magic word.
Right. For anyone investing in the rapidly shifting energy tech space, that is a magic phrase. Think of traditional battery making like baking a cake.
Okay, I like this.
If you decide to change your product from a chocolate cake to a vanilla cake, you have to completely change the liquid batter recipe, right? The mixing process, the baking time, everything.
We start over.
Exactly. But Dragonfly's dry process is more like making a sandwich. Whether you decide to use turkey, which would be your standard lithium-ion, or ham, which might be, say, a new sodium-ion mix, the bread in the assembly line stay exactly the same.
That's a brilliant way to put it.
So if the entire battery industry suddenly shifts toward a new solid-state chemical standard, Dragonfly doesn't have to bulldoze their factories and start from scratch. They just feed the new powder into their existing dry electrode machinery.
What's fascinating here is how that specific technological flexibility directly translates into financial resilience and margin expansion for the company.
Which is what you care about as an investor.
Exactly. You nailed the mechanics of being chemistry agnostic. It entirely future-proofs their capital expenditures. But let's look at the immediate financial impact of skipping those massive drying ovens.
The warehouse ovens we talked about.
Right. Because they aren't running warehouse-sized heaters around the clock, they actually consume 25% less energy during the manufacturing process.
Wow. 25% is a huge cut to overhead.
It's massive. Furthermore, their CO2 footprint is 9% lower.
And doing all of this domestically means they aren't at the mercy of global shipping bottlenecks either.
Exactly. That domestic capability is a massive structural advantage. And they pair this manufacturing edge with their proprietary Dragonfly intelligence communication technology.
That's the software side, right?
Yes. It's the software layer that allows their battery packs to seamlessly talk to the rest of the vehicle systems. Add to that the fact that their cells are UL listed.
Which is a big deal for insurance, right?
It's the gold standard safety certification. Major insurance companies and industrial regulators absolutely require it. So you have a very complete, highly certified package. And they protect all of this with an absolute fortress of intellectual property.
How many patents are we talking about?
We are talking about roughly 100 granted, filed, or pending patents, all built on the back of over 10 years of deep research and development.
Okay, I have to halt the discussion right there.
Uh-oh.
Because if I'm listening to this, I am trying to reconcile two completely different realities right now.
I know exactly where you're going with this.
Right. On one hand, we have a proprietary, future-proof, environmentally bulletproof manufacturing process that skips the most expensive step in battery making.
Yeah.
We have a massive regulatory moat. We have 179% OEM growth and over $225 million in historical revenue. So,
Yeah.
why on earth is their market cap sitting around a paltry $66.06 million? I mean, the market is pricing this company like it's on the verge of bankruptcy.
And that brings us to the severe financial reality we have to address today. The market is exceptionally efficient at pricing risk, and, well, there is a gaping hole in their balance sheet.
Okay, let's look at the exact numbers. Based on the latest data, they currently hold only $2.73 million in cash and equivalents.
Which is very light.
Extremely light. But stacked against that is a massive $65.09 million in debt.
Yeah, that's the elephant in the room.
Just $2.73 million in cash against $65 million in debt. Let's frame that. It is like deciding to build a massive, state-of-the-art toll bridge. It costs an absolute fortune up front in engineering and materials, and you carry massive, suffocating debt while you are building it. Now, once the bridge opens, the operational costs are tiny, and you just sit back and collect tolls. That's your high-margin recurring revenue.
Right, the ultimate goal.
But the market's ultimate fear is, are you going to run out of cash and go bankrupt before the first car ever crosses the bridge?
Exactly.
How does a company survive that kind of cash crunch, especially when their basic earnings per share over the trailing 12 months is an abysmal negative $3.87?
If we connect this to the bigger picture, you really have to look at how their capital structure is designed and where that negative earnings per share is actually originating from.
Okay, explain that.
That negative $3.87 EPS isn't because they are just burning cash on frivolous operational expenses or failing to sell their product.
It's not just flying out the window.
No, it reflects a deliberate, highly aggressive choice to reinvest heavily into the capital expenditures required to scale that dry cell manufacturing capability.
Oh, so they're doubling down on the tech.
Exactly. They are pouring everything back into building out their domestic factory lines and expanding their patent portfolio rather than, hoarding cash or doing things that artificially boost the stock price in the short term, like stock buybacks.
I hear you on the long game, I really do. But negative 3.87 EPS is a massive hole to dig out of. Regardless of how noble the reinvestment is, debt requires servicing.
It absolutely does.
So what is their actual cash runway before they are forced to make a really painful move?
That is the exact question institutional investors are asking right now. That high debt load introduces a very real imminent risk of dilution.
Right, issuing more shares.
Yeah. If their OEM growth hits a speed bump, or if the macroeconomic environment suddenly tightens, they might be forced to issue millions of new shares just to raise capital to keep the lights on.
Which immediately dilutes the value of the shares you currently hold.
Precisely. Alternatively, they could face intense refinancing pressure at highly unfavorable interest rates. And you can see this fear reflected mathematically in their valuation.
How so?
Look at the enterprise value of the company, which calculates what it would cost to buy the company outright by adding the equity value and the debt together. That sits at $128.42 million.
Okay.
But the equity value alone, the market cap you actually see on your stock ticker, is heavily compressed down to that $66.06 million mark.
Oh, I see.
The market is essentially saying, we acknowledge the brilliance of the technology, but we are deeply terrified of the leverage.
So the market is making them prove they can actually outgrow the debt before they give them a premium valuation.
Exactly. Show us the money first.
So given this intense tug of war between an undeniable technological moat and a really heavy debt burden, how is the broader market actually trading this stock right now? Especially considering they just had their Q4 2025 earnings call yesterday.
Right now, the quantitative sentiment scoring across the major financial platforms is perfectly neutral. Yeah. If you analyze the pre-market, intraday, and after-hours sessions from yesterday, there was a noticeable spike in trading volume. They are definitely popping up on the industrials sector mover lists.
But no clear direction.
Exactly. Neither the bulls pushing the tech narrative nor the bears pushing the bankruptcy narrative are establishing clear dominance.
I want to dig into that neutral rating for a second, because sometimes neutral just means well, nobody cares.
Right, like low volume, flatline.
Yeah. But high volume neutral means something entirely different in technical analysis, doesn't it?
It does. When sentiment is perfectly neutral on high volume, it means the panicked sellers have finally met an equal wall of long-term buyers.
Oh, interesting.
The stock stops its downward slide and begins to build what analysts call a basing pattern. It establishes a firm floor of price support.
So the bleeding stops.
Right. The sellers are exhausted, and the buyers are quietly accumulating shares, essentially holding their breath as they wait to see if next quarter's revenue will actually prove their thesis right.
They are digesting the guidance that just came out of yesterday's call.
Precisely. Investors are heavily scrutinizing the operational efficiencies and the path to profitability that management outlined yesterday. And the market is already positioning for the next major catalyst, which will be the mid-June 2026 earnings report.
We also have to factor in a broader macro dynamic here, don't we?
Oh, definitely.
Because there's a distinct sector rotation happening right now where large institutional money is moving out of overvalued tech and into industrials and renewables.
Yes, we are seeing a lot of capital shifting there.
As the global push for grid resilience and sustainability continues, Dragonfly Energy's deep exposure to off-grid and solar markets makes them a prime target for that rotating capital.
And whenever you have a company with cutting-edge, fully patented proprietary tech sitting at a deeply compressed market cap, the rumor mill starts working overtime.
Oh, always. What are the rumors saying?
There has been speculative chatter about their potential in the solid-state battery space, because we established that their dry electrode tech is chemistry agnostic, right?
The sandwich analogy, yes.
Exactly. Rumors suggest this could spark massive mergers and acquisitions interest from much larger energy storage players who just want to acquire that manufacturing capability outright.
I mean, that makes sense. But let's clarify that.
Yeah, it is critical to clearly state that right now, those are unconfirmed, highly speculative rumors. There are no credible M&A actions detailed in the current financial filings.
Right.
However, from a strategic standpoint, it makes perfect logical sense why the market would speculate on that scenario. The intellectual property alone, skipping the toxic solvents and the massive drying ovens, is highly attractive to any legacy battery manufacturer looking to modernize.
So what does this all mean? If you were listening to this, analyzing the data, and trying to figure out how to position your portfolio, what is the actual strategic play?
Right, how do you trade it?
Yeah. Are we trying to day trade the wild volatility around these earnings reports? Or is this something you lock in a vault and ignore for 5 years?
This raises an important question about how to interact with a stock locked in a basing pattern. Based on the complete fundamental analysis, the overarching thesis actually warrants a bullish score of 7 out of 10.
7 out of 10.
Yeah. The only reason it is not a 9 or a 10 is strictly because of that terrifying leverage and the extremely low cash reserves.
The $65 million debt.
Exactly. So for your wealth building strategy, the approach here is actually dual-pronged. First, the heavy debt practically guarantees you are going to see short-term volatility.
Which means opportunity.
Right. That creates highly specific opportunities for swing trades around the quarterly earnings reports. You buy the unwarranted dips when the market overreacts to the debt load, and you capture gains when the OEM growth numbers inevitably shine.
So you actively trade the fear and the greed in the short term. What about the core position, though?
Simultaneously, the target horizon for your core investment is a multi-year hold. You are holding in anticipation of the dry electrode manufacturing reaching mass scale and producing serious free cash flow, alongside the potential for those solid-state battery breakthroughs.
It's a waiting game for the tech to fully mature.
Yes. And the fact that they already have 179% OEM growth and 400,000 deployed packs fundamentally de-risks a significant portion of the long-term operational upside. They have already proven they can sell the product. Now they just have to prove they can manage the balance sheet.
It really is a fascinating high-stakes setup. Let's synthesize the core tension for your wealth-building journey today.
To get
On one side of the scale, Dragonfly Energy offers an incredibly undervalued entry point into top-tier, highly scalable domestic battery technology. I mean, they have the patents, they have the massive environmental and regulatory edge by avoiding those toxic chemicals, and they are deeply embedded in the physical architecture of OEM supply chains.
the intel inside.
Exactly. But on the exact opposite side of the scale, taking a position here absolutely demands an iron stomach. You have to be willing to weather the severe realities of their $65 million debt leverage and the inevitable short-term earnings volatility as they attempt to scale out of that hole.
And as you weigh those two opposing forces against each other, I really want you to consider this final, lingering reality about their intellectual property.
Give it to us.
We know their dry electrode manufacturing is completely chemistry agnostic. We know it requires 25% less energy, and we know it's protected by roughly 100 patents.
Right.
So are we really looking at a company whose ultimate final goal is to just sell RV and marine batteries forever?
Hmm.
Or by quietly building and patenting a universal, highly efficient manufacturing process, are they actually positioning themselves as the ultimate turnkey acquisition target?
Wow.
Imagine a massive global energy giant, a company that would much rather write a check to acquire Dragonfly Energy today than spend the next decade and billions of dollars trying to replicate technology that Dragonfly has already patented.
That is exactly the kind of critical long-term question you need to be asking when you look at a compressed market cap like this. Thank you so much for joining Smart Wealth with Joshua today. Keep analyzing the data, keep managing your risk, and above all, keep questioning the market. We'll see you next time.